This one comes into us from the Reserve Bank. The Reserve Bank, in a discussion paper, wants to impose tougher rules on banks lending to large corporates. Now, the central bank in that paper has proposed limits on large loans to curb the concentration in a particular sector. What does this mean in plain English? Lata joins us now with the details. Lata, to start with, this is a discussion paper that the central bank has put out. What is it going to mean now for large conglomerates, large corporate groups who are leveraged at this point in time? And what does this finally mean in terms of the ability of bankers to lend to those groups?
Well, it's going to get tough for banks to lend to large groups, and it is going to get tough for large indebted groups to get more money out of banks. They will get the money, but at a price. This is how the situation stands now. There are limits on how much one bank can lend to one group. They can't lend more than 25% of their net worth. But there are no systemic limits. There is no limit to how much one borrower can take from the entire system. And that is why you have a situation where there are, the top 10 leveraged groups have almost 35% of the total money of the banking system, each one having about anything between 50,000 crore to 1 lakh crore in terms of loans from a whole host of banks. The exposure is particularly acute in infrastructure, power, steel, and such companies. Now, what the Reserve Bank is proposing is that it identifies some of the high leveraged limits. That is, companies with over 25,000 crores will be considered highly leveraged companies, and that limit will be brought down as the banking system gets used to it. Now, what the Reserve Bank says is if banks take more exposure than 25,000 crores in FY 17-18, the rules kick in only in the next year, then they will have to keep 3% provisioning. Now the standard provisioning is 0.4%. It has to be increased to 3% so that you are adequately buffered for risk. Also, the risk weight, that is the capital that will have to be set aside, should be 75%, and therefore it becomes a little difficult to lend to these groups. What the RBI also says is that in the first year, that is FY 17-18, banks could convert the remaining portion into bonds and then in subsequent years sell it off. Sell off 30% in FY 19 and 60% in FY 20 and the entire amount in FY 21. So basically it is giving banks time up until FY 21 to adjust and bring down their exposure to the highly levered groups. Obviously, life will become a little tougher for the highly levered groups as well as to the banks because they have to provide more and convert some of them into bonds. That's the framework proposed. We have Dr. K.C. Chakrabarty once again joining us. Dr. Chakrabarty, we seem to keep you busy since there are so many rules coming for banks. What did you make of this sector-wide limits? Make sense?
Yeah, you see, look, in a critical time it makes sense, but it is very difficult to implement. The problem is that if the borrower is not able to get the money from anywhere else, he will not get the money from the bank. Okay, that is going to happen. But the issue is that, yes, over a period of time, group exposure limit has to be reduced. It has to be made 25%. Now, if they require more, then from there, where will they get the money? They have to go to market and borrow the money. So, overall direction is okay. But this individual borrower-based system as a whole, to impose a limit and why it should be 25,000 crore because next year why it should be 27,000 crore, that is a little bit more micromanagement. I think it would be much better to get a percentage. That, for example, you cannot borrow more than 25%, you cannot borrow more than 10% individual bank. But then these are all difficult times. You see, it is very easy to tell me that, okay, it should not happen, but ultimately you have to reduce the leverage. But believe me, the problem is not that. Problem is that borrowers have no capital. That's the critical issue.
Yeah, no, that is a separate issue. That is a separate issue. I agree with you, sir.
But you are diversifying the debt, but he has no capital.
Okay, but
the problem is that it is not going to solve your problem.
Dr. Chakrabarty, the system has been given time till 2021 to adjust. So is it possible that these highly levered groups will be able to find equity by then?
That is the issue. If they get, then it is okay. But more than that, by 21, automatically, today what is 25,000, it should be 30,000 because you must know there is inflation.
Yeah.
The time value of money is there. So the issue is that, you see, look, that is why it is very difficult. Many of these monetary ceilings, you see, it becomes useless after some time because you don't review it every year along with the inflation. Then what is going to happen?
Yeah, point taken, sir. sir. Point taken. Instead of giving hard monetary limits, the Reserve Bank should perhaps replace it with percentage limits. That exposure to the entire banking sector should not be more than 25% or 10% or whatever number the Reserve Bank chooses. Do you think this will forcibly create a bond market?
Yeah, partly it is there, definitely. You see, look, those who want and those who can raise the money, they have today any amount I am borrowing from the bank. Now that you cannot get once the banking system, your exposure is already there is a ceiling. Then additional fund if you require, you have to borrow from the market. And that's why that will explain. And not only market, banks will be not able to subscribe. It is other players have to subscribe the bond. So you are diversifying the source of the funding, that's the thing. And thereby you are reducing the leverage of the bank. But believe me, you are not taking away the risk from the financial system.
Yes.
Now, if you are saying you are reducing the leveraging, it is not going to happen. Because financial system remains leveraged, borrowers remain leveraged.
Fair enough. Fair enough, sir. Thank you very much for joining us with your quick take. So, Shireen, key takeaways. One, the Reserve Bank wants to reduce the overall banking sector's exposure to over-levered groups. It is going to do that by higher provisioning and higher risk weight advice, and also forcing the banks to convert them into bonds and eventually selling off the bonds. So, probably also, therefore, forcibly creating a corporate bond market. Discussion paper advice will be welcome, and let's see how the final rules look.
And there's plenty of commentary that's already started right here on CNBC TV 18. Lata, appreciate you joining us with those details. Now,